When a 95-year-old man makes the biggest financial decision of his life, it's not about making more money. It's about avoiding catastrophic risk. Warren Buffett just stepped down as CEO of Berkshire Hathaway on January 1st, 2026, after 60 years. But before he left, he positioned the company in a way that tells you everything about what he sees coming. And if you're invested in America, if you have retirement savings, if you trust the market to protect your future, what Buffett is doing right now should make you pause and think very carefully about whether your assumptions still hold. If you invest in America, if you have a retirement plan, if you depend on markets functioning normally, this isn't just Warren Buffett's story. This is a signal about your financial future. Because when the most successful investor in history stops buying and starts building cash at levels never seen before, when he sells more stock than he buys for 12 consecutive quarters, when he accumulates $381.7 billion in cash while everyone else chases artificial intelligence and record stock prices, he's telling you something without saying it directly. He's telling you that what everyone assumes is safe might not be, that what everyone believes will keep working might stop, that the comfort you feel watching your portfolio rise could be the exact moment when the smartest money in the world is quietly preparing for something very different. This man has seen financial bubbles inflate and explode. He lived through the 1970s stagflation, the 1987 crash, the dot-com bubble, the 2008 financial crisis, the COVID panic. Every single time he positioned Berkshire to survive what destroyed everyone else, and every single time people watching him thought he was being too cautious, too conservative, missing opportunity. Until the crash came, until the assumptions collapsed, until the only people left standing were the ones who prepared while everyone else chased returns. Right now, Warren Buffett is preparing again, not publicly, not dramatically, quietly, systematically, building the largest cash position in corporate history. And when Buffett moves like this, history says ignoring it is expensive, very expensive. Let me take you back to 2008 because this pattern matters. Before Lehman Brothers collapsed, before the financial system nearly broke, Warren Buffett was doing something that confused everyone. He was selling. In 2007, while markets climbed to record highs, Berkshire reduced stock positions, built cash, sat on the sidelines. Investors complained. They said he was missing the boom, that he'd lost his touch, that the world had changed and Buffett didn't understand new financial instruments and structured products. Then, September 2008 arrived. Lehman failed. AIG collapsed. Credit markets froze. Stock prices fell 50%. Retirement accounts evaporated. And Warren Buffett, sitting on massive cash reserves, became the lender of last resort. He made deals nobody else could make. Goldman Sachs, General Electric, Bank of America. Investments at terms that generated billions in profits because he had cash when everyone else needed it desperately. The people who mocked his caution in 2007 spent years recovering losses. Buffett spent years compounding wealth. That's the pattern. Buffett doesn't predict crashes. He positions for them. He builds fortress balance sheets that survive worst-case scenarios. And right now, he's building the biggest fortress in Berkshire's history, $381.7 billion in cash and short-term investments as of September 30th, 2025. That's not normal. That's not prudent diversification. That's preparation for systemic stress. Let me show you what this looks like in stages. Great investors don't predict markets. They read systems. And when systems become unstable, smart money doesn't attack. It defends. This unfolds in 4 phases. Phase 1, the confidence era. This is where we've been for years. Stock prices climbing, artificial intelligence driving valuations higher, corporate earnings strong, unemployment low, markets hitting all-time highs repeatedly. Everyone feels confident. Retail investors pile in. Institutional money chases momentum. The narrative is growth, innovation, disruption. Nobody talks about risk. Nobody prices. And the possibility that this ends. Everyone assumes this is the new normal. Markets can stay elevated because earnings justify valuations and the economy remains resilient. Phase 2, the blind risk. This is where the cracks appear but get dismissed. Warren Buffett has been a net seller of stocks for 12 consecutive quarters. That means from the fourth quarter of 2022 through the third quarter of 2025, Berkshire sold more stock than it bought every single quarter. The cumulative amount, $184 billion in net stock sales. Not because these companies failed, not because Buffett stopped believing in American business, but because valuations reached levels where he couldn't find good value, where the prices didn't justify the risk, where holding cash became more attractive than buying stocks at prevailing prices. Look at what he sold. Apple, his favorite stock, his largest position. Berkshire owned over 900 million shares of Apple at peak. Now it owns 238 million. He sold 74% of the position. Bank of America, trimmed by 26.3 million shares in the third quarter of 2025 alone. These aren't stocks Buffett hates. These are stocks he loves that got too expensive. The S&P 500 Shiller-Cape ratio, a measure of market valuation, hit 40 in November 2025. That's higher than any time except the dot-com bubble and the COVID peak. When valuations reach 40, historical data shows the market typically declines 30% over the next 3 years. That's not prediction. That's pattern recognition from a century of market history. Buffett sees this. The market ignores it. Phase 3, the quiet shift. This is happening right now. Buffett sold $12.5 billion in stocks in the third quarter of 2025, bought $6.4 billion, net seller for the 12th straight quarter. But here's what most people miss. He didn't just sell stocks. He stopped buying Berkshire stock too. For the first 9 months of 2025, Berkshire conducted 0 share buybacks. None. Buffett has always said he'll buy back Berkshire shares when they trade below intrinsic value. The stock fell 14% from its May peak to its August low in 2025. A massive buying opportunity if Buffett thought the stock was cheap. He bought nothing. That tells you he thinks even Berkshire, the company he built, the stock he knows better than any other, isn't cheap enough at current prices to deploy cash. If Berkshire isn't worth buying, what is? Meanwhile, the cash kept building. Started 2022 at $105 billion, climbed to $150 billion during COVID, now $381.7 billion, more than double the previous peak. The cash position now exceeds the value of Berkshire's entire stock portfolio. $267 billion in stocks, $381 billion in cash. Think about what that means. The man who built his fortune, buying wonderful companies at fair prices, now holds more cash than stocks. He's positioned for defense, not offense. Phase 4, the defensive bet. This is the phase that defines everything. Warren Buffett didn't stop loving stocks. He didn't lose faith in American business. He made a calculated decision that at current valuations, at current economic conditions, at current levels of market euphoria, holding cash is smarter than deploying it. This isn't pessimism. This is risk management. Because cash does 2 things that stocks can't do during market dislocations. First, it preserves capital. When markets fall 30 to 50%, cash doesn't fall. It holds value. Second, it provides opportunity. When everyone else needs to sell, cash lets you buy at distressed prices. Buffett learned this in 2008. He's preparing to use it again. Now let me show you exactly what this bet represents. Buffett didn't stop buying stocks entirely. He made one major new investment in the third quarter of 2025. Alphabet. $4.3 billion position. The first major technology investment outside of Apple. But even that investment is revealing. Alphabet trades at a lower valuation than most mega-cap tech stocks. It generates massive free cash flow. It has dominant market positions in search and advertising. This isn't speculative growth. This is quality at a reasonable price, the exact kind of investment Buffett makes when he does deploy capital. But $4.3 billion out of $381 billion in cash, that's 1.1%. He's keeping 98.9% on the sidelines. That ratio tells you everything. Here's what Buffett's positioning means for you directly. This doesn't mean markets crash tomorrow. This doesn't mean you should sell everything and hide in cash. What it means is that the assumptions driving market behavior right now, that stocks always go up, that valuations don't matter, that artificial intelligence justifies any price. Those assumptions are being rejected by the investor with the best track record in history. And when assumptions diverge that dramatically between the market and Warren Buffett, history suggests Buffett is usually right, and the market is usually shocked when reality catches up. If you're invested in stocks right now, understand what you're betting on. You're betting that the S&P 500 CAPE ratio of 40 is justified by future earnings growth that hasn't happened yet. You're betting that corporate profit margins at record highs can stay there indefinitely. You're betting that interest rates don't spike, that credit doesn't tighten, that economic growth continues smoothly, that artificial intelligence generates the trillions in value that current stock prices assume. Some of those bets might pay off, but all of them have to pay off simultaneously for current valuations to make sense. Buffett is betting they don't. If you're saving for retirement, think about what happens when the market reprices risk. You don't lose everything, but you might lose 20 to 40% of your portfolio value. If you're 60 years old and planning to retire at 65, that loss changes everything. The recovery might take 5 to 7 years. You might be 70 before your portfolio gets back to where it was at 60. That's not catastrophe, but it's also not the plan. And it's exactly the kind of slow wealth destruction that happens when people assume markets always recover quickly. Sometimes they do, sometimes they don't. 2008 took 5 years to recover. The dot-com crash took 13 years for the NASDAQ to get back to peak. Buffett is positioning to avoid that pain. If you're younger and have decades until retirement, market volatility matters less. You can ride through corrections. You can buy during crashes. Dollar cost averaging works over long time horizons. But even for young investors, understanding cycles matters. If the market drops 30% and you keep buying, you'll do well eventually. If the market drops 30% and you panic sell, you lock in losses permanently. Buffett's positioning is a reminder that markets don't just go up, they cycle. And right now, we're late in a cycle that's been running since the COVID bottom in March 2020. 4.5 years of nearly uninterrupted gains. History says those don't last forever. Now let me address what I know you're thinking. Markets have been expensive before and kept rising. The CAPE ratio hit 40 in late 2019 and early 2020. Markets kept climbing. Why should this time be different? Fair question. The difference is context. In 2019 and 2020, interest rates were near zero. The Federal Reserve was actively supporting markets. Corporate earnings were growing. In 2025 and 2026, interest rates are above 5%. The Federal Reserve is shrinking its balance sheet. Corporate earnings growth is slowing. The backdrop that justified high valuations during COVID doesn't exist anymore. Buffett sees that. The market hasn't adjusted yet. Here's what Buffett is actually betting on with his cash position. He's not betting stocks crash. He's betting that at some point in the next few years, probably sooner rather than later, valuations will adjust to reflect slower growth and higher rates. When that happens, the companies Buffett wants to own will trade at prices that make sense, and he'll deploy that $381 billion in cash. Not all at once, but systematically, buying wonderful businesses at fair or even cheap prices, the same strategy that made him wealthy over 60 years. He's just waiting for the right pitch. And right now, the market isn't throwing strikes. It's throwing overpriced pitches that Buffett refuses to swing at. Let me show you what this looks like historically. During the COVID crash in March 2020, Berkshire sat on $128 billion in cash. The market fell 34% in 3 weeks. Buffett deployed capital selectively. He didn't catch the exact bottom. But he bought quality companies at reasonable prices. Occidental Petroleum, Verizon, Chevron. Those investments generated billions in returns as markets recovered. The same pattern played out in 2008 and 2009. Berkshire entered the crisis with cash, deployed it during panic, made enormous returns. Now Berkshire has $381 billion, 3 times more than during COVID. Buffett is preparing for something bigger than COVID, or he sees opportunities coming that require more capital than ever before. Either way, he's not building this cash pile because he's running out of ideas. He's building it because he knows what comes next. On December 31st, 2025, Warren Buffett officially stepped down as CEO of Berkshire Hathaway. Greg Abel, age 63, took over on January 1st, 2026. Buffett remains chairman of the board, but the day-to-day management, the capital allocation decisions, the strategic direction, those now belong to Abel. This transition matters for one critical reason. Buffett wouldn't hand over control if he thought the next few years would be smooth sailing requiring aggressive stock buying. He handed over during a period of unprecedented cash accumulation because the hard work of building defensive position is done. What comes next, whether it's deploying that cash during market distress or managing through economic turbulence, that's Abel's job now. Buffett positioned the company. Abel inherits the strongest balance sheet in corporate America exactly when it might matter most. Let me show you what the market is telling you versus what Buffett is telling you. The market says valuations are justified by artificial intelligence growth, that earnings will keep rising, that economic expansion continues, that stocks are the best place for capital. Buffett says cash is better, that valuations are too high, that opportunities are scarce, that patience is required. One of these perspectives will be proven right over the next few years. History says betting against Warren Buffett during periods like this is a very expensive mistake, because Buffett doesn't panic. He doesn't overreact. When he builds cash positions this large, he's not being fearful, he's being rational, and the market is being emotional. Here's what you should actually do with this information. First, understand your own risk tolerance and timeline. If you're 5 years from retirement and heavily invested in stocks at current valuations, you're exposed to a sequence of returns risk. A market correction in the next 2 years could permanently damage your retirement plans. If you're 30 years from retirement, short-term volatility matters much less. Your actions should reflect your specific situation, not generic advice. Second, consider whether you're comfortable with current valuations. If you think the S&P 500 CAPE ratio of 40 is reasonable and sustainable, stay invested. If you think it's elevated and likely to mean revert, consider reducing equity exposure. There's no perfect answer. But alignment between your beliefs and your portfolio matters. Third, build cash reserves if you don't have them, not because markets will definitely crash, but because having liquidity when opportunities arrive changes everything. Buffett can make investments during crashes that generate decades of returns precisely because he held cash while everyone else was fully invested. You can't replicate Berkshire's scale, but you can replicate the logic. Having cash when assets get cheap is worth more than being fully invested during expensive markets. Fourth, stop assuming stocks always go up. They don't. Over long periods, they tend to rise, but decades matter. The Nasdaq peaked in March 2000 at 5,048. It didn't permanently exceed that level until April 2015. 15 years. If you bought at the peak and held, you eventually recovered. But 15 years is a long time. 15 years during your prime earning years or your retirement years can't be recovered. Buffett knows this. The current market acts like it doesn't. Fifth, recognize that legends don't chase returns. They avoid traps. Warren Buffett, at 95, has nothing to prove. No performance fees to earn. No investors to impress. He could deploy that $381 billion tomorrow into stocks and generate enormous short-term results if markets keep rising. He's choosing not to. That choice carries more weight than any analyst report or market forecast because it's backed by 60 years of being right when everyone else was wrong. When Buffett moves, the system is speaking. Right now it's saying valuations are too high. Risk is underpriced. Patience is required. You can listen or ignore. History says listening is smarter. The most important thing Warren Buffett did at age 95 wasn't stepping down as CEO. It was positioning Berkshire Hathaway to survive and thrive through whatever comes next. $381.7 billion in cash, $267 billion in carefully selected stocks, 0 share buybacks despite stock price weakness, 12 consecutive quarters of net selling, a new CEO inheriting the strongest balance sheet in corporate history. This isn't pessimism. This is preparation. This is what smart money does when everyone else is euphoric. It builds fortresses, conserves capital, waits for opportunity, and when opportunity arrives, it acts decisively while everyone else is paralyzed. But here's what makes this positioning even more extraordinary. Berkshire isn't just sitting on cash doing nothing. The company generated $13.5 billion in operating earnings in the third quarter of 2025. That's a 34% increase from the prior year. Insurance underwriting profits more than tripled to $2.4 billion. The insurance float, money that others pay Berkshire through premiums that Berkshire gets to invest, reached $176 billion. That's $5 billion more than the end of 2024. BNSF Railroad generated $1.4 billion in quarterly earnings. Berkshire Hathaway Energy produced $1.5 billion despite regulatory challenges. Manufacturing, service, and retailing businesses contributed $3.6 billion. These are real operating businesses generating real profits. This isn't a hedge fund waiting for markets to crash. This is an industrial conglomerate that happens to be run by someone who understands market cycles better than anyone alive. The 4 businesses Buffett calls the jewels of Berkshire, insurance, BNSF Railroad, Berkshire Hathaway Energy, and Apple stock, continue performing exactly as designed. Insurance operations have generated $32 billion in after-tax profits from underwriting since Buffett took control. The float grew from nothing in 1965 to $176 billion today. That's $176 billion of other people's money that Berkshire invests while they wait for claims. If Berkshire earns just 5% annually on that float, that's $8.8 billion in investment income before paying out claims. BNSF moves more freight by volume than any railroad in America. Earnings grew from $122 million when Berkshire bought the business to over $1.4 billion quarterly. Berkshire Hathaway Energy operates regulated utilities serving millions of customers. These businesses don't disappear during recessions. They generate cash through economic cycles, and that cash funds the fortress balance sheet Buffett built. This is why Buffett's cash position is so significant. He's not holding $381 billion because Berkshire stopped making money. He's holding it because he's making so much money from operations that he can't find enough attractively priced investments to deploy it all. Think about what that means. Berkshire generates roughly $50 billion in operating earnings annually. After funding operations, paying taxes, and maintaining the businesses, there's still tens of billions left over. Normally, that cash would buy more stocks, make acquisitions, or return to shareholders through buybacks. Instead, it's accumulating, growing every quarter. Because Buffett would rather sit on cash, earning 5% in treasury bills, than deploy it into overvalued stocks or overpriced acquisitions. That discipline is what separates great investors from average ones. Average investors feel pressure to put cash to work. Great investors wait for prices that make sense. Now let me show you what Buffett is telling you through Berkshire's operating performance. Insurance underwriting, the business of collecting premiums and paying claims while hopefully keeping some profit, generated $2.4 billion in the third quarter. That's more than triple the $750 million from the same quarter in 2024. This happened despite catastrophe losses from hurricanes and other disasters. The combined ratio, which measures how much insurers pay out in claims and expenses relative to premiums collected, improved significantly. When the combined ratio is below 100, the insurer makes underwriting profit. Berkshire's insurance operations consistently achieve this. Most insurers lose money on underwriting and make it back through investment income. Berkshire makes money both ways. Profit from underwriting plus